Welcome to TalkTickers. Today, we're diving straight into the highlights from the latest FIS earnings call.
Yeah, lots to cover. We're looking at what these numbers really mean for, well, the company's direction.
Exactly. We've got a snapshot of their first quarter, plus some pretty big strategic moves they've talked about.
So let's break it down for you.
Okay, right out of the gate, FIS showed a strong start to the year. Their adjusted revenue grew by 4%.
And what's interesting there is it actually beat their own expectations.
That's a good sign, isn't it?
Definitely. And beyond that, their recurring revenue growth really picked up speed. It went from 2% last quarter to 4% this quarter.
Doubled. That kind of growth in, the steady income streams suggests more stability.
Exactly. That consistency is key.
And the good news kept coming. Adjusted EBITDA was at the high end of their outlook range.
And free cash flow looked healthy too, conversion over 70%.
Really strong. Even adjusted EPS, their earnings per share, jumped 11% to $1.21.
Again, hitting that upper end of the outlook. It all points to, solid operations and good management.
And they didn't just make money, they gave some back. $670 million returned to shareholders.
Right, through both share buybacks and dividends. Shows financial discipline, commitment to value return.
And importantly, looking ahead, they reaffirmed their full-year outlook.
Which signals confidence, right, that they think this momentum will continue.
Okay, so those are the big headline numbers. Let's really dig into what's actually driving this, starting with this focus on commercial excellence and strengthening their portfolio.
Yeah, this commercial excellence thing seems like a company-wide push.
Yeah.
Basically optimizing how they sell, how they manage clients.
And you combine that with simplifying their offerings, strengthening what they sell.
And it appears those moves are starting to, deliver results.
They also emphasize their business model, particularly the high recurring revenue.
Right. They say that gives them consistency, helps them weather, broader economic shifts.
Okay, now, here's where it gets really interesting. The big strategic deals they announced.
Yes, this is significant. The planned acquisition of global payments issuer business and, at the same time, selling their minority stake in Worldpay.
That Worldpay stake sale, $6.6 billion pre-tax, and they mentioned it was at a premium.
Yeah, it suggests a strategic choice, maybe monetizing that asset faster than waiting for a potential IPO down the line.
And it looks like they're putting that capital, or a chunk of it, right back to work, buying the issuer solutions business for a net enterprise value of $12 billion.
And that includes a pretty substantial tax benefit, about $1.5 billion.
And these two big moves, the sale and the purchase, are expected to close around the same time.
First half of 2026 is what they said. They expect them to happen simultaneously.
So this is issuer solutions business. What does it actually bring to FIS?
Well, it adds credit processing capabilities. It fits right alongside their existing banking solutions.
Complementary, then.
Exactly. And that could open up, significant chances to cross-sell new services to their current bank clients.
And they're projecting some real benefits from this deal. Boosts to adjusted EPS, margins, free cash flow.
All within the first year, they expect.
Yeah.
And potentially greater benefits long-term from synergies as they integrate everything.
It really feels like a strategic play to beef up their financial position and their market standing.
Absolutely. More recurring revenue, more free cash flow. Those are the key outcomes investors will be watching closely.
Okay, let's pivot a bit. How are they doing on winning new business, solidifying their market position?
Well, they reported signing several marquee new engagements, as they put it, across the money life cycle.
Sounds like momentum is building into the second quarter, too.
Yeah. And they said demand for their core solutions is still strong. They're expecting another solid year for sales.
Did they give any specifics?
They did. For instance, a big East Coast commercial bank, over $15 billion in assets, chose their IBS core banking platform.
After a competitive review following an acquisition. That's interesting.
It highlights their strength with larger banks, the depth of their product set, and maybe even improve client retention, right? Keeping clients through consolidation.
And what about digital? Are they seeing traction there?
Seems so. A Midwest community bank, also over $15 billion in assets, picked their Digital One product for branch teller tech.
And they called that a competitive takeaway.
Yeah, meaning they likely won that business directly from a competitor. Shows they're competing well in that digital transformation space.
It's not just banks either, is it? Their Office of the CFO stuff.
Right. That seems to be resonating more broadly. They expanded a relationship with a big multinational engineering and tech firm.
For treasury management and payment solutions.
Including their payments hub. So yeah, moving beyond just traditional financial institutions.
And they're even pushing into newer areas like private equity, private capital.
Yep. Atlas SP, a global private credit firm, chose their commercial lending solution. That's their first direct lender client in that space.
Plus, a buy-side firm picked their derivatives processing solution.
Right, helping them with self-clearing capabilities. It really shows the range, the adaptability of their solutions across different parts of finance.
Okay, let's get into the nitty-gritty of the financials. How did the individual segments perform?
So the banking segment, revenue grew 2%, which was actually ahead of their outlook.
And recurring revenue within banking?
3%. Non-recurring was also up 3%, which helped offset some headwinds from license fees. Strong card production helped there.
What about professional services in banking?
That declined 5%, but they expect it to accelerate later in the year.
And the banking profit margin, the EBITDA margin?
They contracted a bit. They pointed to some fees from last year and expense timing as the main reasons. So context is important there.
Okay, how about capital markets?
That segment had a really strong Q1. Revenue jumped 9%, again, ahead of their outlook.
Recurring revenue up 6%, but non-recurring surge.
Yeah, up 47%, mostly due to strong license renewals, it sounds like.
Professional services there also dipped 5%.
Correct, but again, expected to return to growth.
And the margin in capital markets?
Expanded nicely. They attributed that to the high margin license revenue and just operating leverage kicking in. That segment's really driving growth right now.
So looking ahead near term, full year outlook is unchanged.
Right. No changes to Q assumptions.
But for Q2 specifically?
They're projecting adjusted revenue growth of about 4.2% to 5%.
Broken down?
Banking expected between 3.7% and 4.4%. Capital markets between 6% and 6.7%.
So capital markets growth in the first half is actually running a bit hotter than the full year expectation.
Seems that way, yeah. Modestly ahead.
And what about profit margins overall?
They expect a decent sequential improvement, around 200 basis points in Q2. Targeting roughly 39.8% to 40%.
And for the full year?
Continued improvement to 41.3%. So clearly focused on boosting profitability.
But the adjusted EPS growth for Q2 looks a bit muted. $1.34 to $1.38. That's like 0% to 3% growth.
Yeah, they flagged that. It's mainly due to lapping some specific things from last year. Interest income they got from the initial Worldpay proceeds last year, and also just a really strong comparison period for the Worldpay EMI business back then.
Ah, okay. So tough comps, basically.
Exactly. It reminds you that year-over-year growth can be skewed by one-offs.
What is on the financials? Capital spending, leverage, buybacks.
CapEx was $233 million, about 9% of revenue, which they said was expected. Target leverage is still 2.8 times, and they're on track for that $1.2 billion annual share buyback goal.
Okay, let's shift to the Q&A insights. What did management add during the call? Client conversions, for instance.
Sounds like those are progressing well. They said it's showing up in the banking revenue guidance. And the pipeline, the potential deals, remain strong.
Because their services are essential. Right?
That's their reasoning. Yeah. Sticky business.
What about feedback on that big issuer solutions acquisition?
Apparently very positive from clients. They mentioned clients recognize the strong brand and see the strategic fit, focusing on financial institutions. That's a good early sign for integration.
Any view on the Capital One Discover merger?
They see it as positive, actually. Expect to continue partnering with them.
And that slightly lower Q2 growth guidance for capital markets. You mentioned the Q1 non-recurring benefit.
Right. They clarified it's mostly timing. The underlying recurring revenue trend is still consistent.
Let's talk more about the acquisition impact. How much revenue does it add to banking? Margin impact.
Adds about 35% to banking revenue is the estimate, and expected to be margin accretive by around 80 basis points overall.
And the acquired business itself?
Management highlighted its durable revenue, long-tenured clients, very stable.
What about Worldpay, the part they still have exposure to through the stake?
The outlook for Worldpay's merchant business, EMI, is consistent with guidance, still expecting strong growth. They feel separating Worldpay was the right call, led to better performance.
Synergies from the issuer acquisition, where do they see the easiest wins?
Cost synergies first. Lowest hanging fruit is apparently rationalizing duplicate vendor costs, then back office optimization.
And they expect those cost savings quickly.
Relatively quickly, yes. Revenue synergies, like from cross-selling, they see building over a longer time frame.
Interesting. And while the deal boosts EPS immediately,
management seemed to emphasize the cash flow impact more. around $700 million increase annually, and just strengthening the overall banking business.
That's the bigger strategic win for them.
Seems to be how they view it. Plus the cross-selling opportunities across banking, capital markets, debit, and now credit. That's the core rationale.
Okay, banking revenue is expected to accelerate in the second half. What's driving that? New sales?
Mostly no. About 150 basis points of that acceleration is attributed to commercial excellence,
Which means?
primarily reflecting deals already sold, especially from a strong 2024, plus high retention rates. So it's not heavily dependent on landing big new deals in the second half, more baked in.
Makes sense. What about free cash flow improvements?
Net working capital optimization is a big factor, specifically focusing on extending payment terms with their vendors.
And CapEx for the combined company post-acquisition?
Expected to stay around 8% of revenue near term, partly due to ongoing modernization efforts within the business they're buying.
How are sales looking in capital markets now?
Progressing well, they said, both in traditional areas like trading and processing, and also those non-traditional verticals, private credit, hedge funds.
Driven by new products and cross-selling.
Yeah, benefiting from new capabilities and leveraging existing relationships.
Any worries about negative impacts, dyssynergies from selling the rest of Worldpay?
No, they don't expect anything significant beyond what was already accounted for during the initial separation.
And finally, ACV growth annualized contract value.
Trending positively. Strong performance in core and digital, consistent with year-over-year trends. Again, supported by those commercial excellence programs focusing on new sales, cross-selling, and retention.
And the Capital One Discover approval doesn't really change much for them.
Not materially, it seems. Still an important relationship, but doesn't fundamentally alter their existing partnership.
Okay, so wrapping up the analysis, key takeaways for you. What's the big picture here?
Well, first quarter was definitely solid, good performance, and reaffirming the full-year outlook signals, confidence in their execution.
And the strategic moves are huge.
Absolutely. Buying the issuer business, selling Worldpay, that's a major transformation. Shifting focus more towards those higher growth recurring revenue streams in Fintech.
The focus on commercial excellence, better retention, that seems to be working.
The results suggest it is, strengthening their competitive position.
And their commentary suggests they feel somewhat insulated from macro headwinds.
Yeah, because their services are seen as essential. That provides a degree of resilience.
Plus, margin expansion hopes and strong cash flow point to better financial efficiency.
Which is ultimately what investors like to see, improving profitability, potential for returns.
Okay, now for our favorite part. The This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea.
All right, let's hear it.
Given the upcoming Issuer Solutions acquisition and FIS's plan to cross-sell credit processing, how about this? Consider a long position in companies that provide ancillary services to credit card issuers.
Like what specifically?
Think fraud detection, specialized customer service platforms, maybe data analytics focused on credit portfolios. The idea is, as FIS potentially ramps up its credit processing volume through cross-selling, the demand for these sophisticated support tools might increase.
Interesting. So betting on the ecosystem around the expanded FIS offering.
Exactly. But highly speculative, of course. It hinges on successful integration, successful cross-selling by FIS, and assumes those clients will actually turn to these third-party providers. Not guaranteed at all.
Got it. Definitely outrageous, possibly plausible.
Any other ideas?
Maybe a contrarian one. With the reaffirmed buyback commitment and strong cash flow, the positive news might be priced in.
Right.
So perhaps a short-term put option strategy, betting against sustained momentum if the market reaction has already happened.
Higher risk, certainly. For sophisticated investors only. Absolutely. Always do your own thorough research before any trade.
Okay, that wraps up our deep dive into the FIS earnings call. A robust start to the year. Some really significant strategic shifts underway.
Definitely a lot to watch. Remember, everything we've discussed today is purely for informational purposes. It is absolutely not financial advice.
We strongly encourage you to do your own research, look at the company filings, understand the broader fintech landscape.
And think about it yourself. What's your take on these strategic shifts? What other opportunities or potential challenges do you see for FIS down the road? Would be interested to hear your thoughts.